How's it going, everyone? Welcome to the MIU, the Mortgage Intelligently University. This is episode 10. And today we're going to talk about a topic that we get a lot of questions about. The topic is, do you really need 20% to buy a house? A lot of people sit on the sidelines waiting to save 20%, which becomes a monumental task, especially in today's world of inflation, higher prices, and things of that nature. So we're going to have Ray, our resident expert, discuss what do you really need to put down to buy a house and discuss the options that you guys may have available. Ray, if you don't mind, talking on this topic, because it's something we get all the time. And I think a lot of homeowners or future homeowners would benefit from knowing what they actually do need.
Absolutely. So thanks, Amir, for the introduction. Welcome, everybody, to our Mortgage Intelligently University episode. And like Amir said, today we're talking about, do you really need 20% down? And unfortunately, there's a lot of myths out there that, a lot of borrowers do believe that you do need 20% down in order to purchase a property. And also, like Amir said, this really becomes a big road bump or block for them, especially a mental block for them when they're looking at homes, thinking that they cannot get into a property without having that 20% down. And obviously, especially in the markets in today's environment, that's no small feat. I mean, that's a large amount of cash. So the easy answer is no, you do not need 20% down. You do not need it for conventional financing. You do not need it for FHA loans, or government loans, VA loans, USDA loans, and you don't even need it for jumbo loans anymore. So that's the easy answer. Now, how do you get around, avoiding 20% down, and what are the options available to clients, to your borrowers? So the initial option is, and the first option is to do loans with, let's say, if someone is putting a 5% down payment or a 3% down payment, you can get what's called mortgage insurance, where the mortgage insurance insures the loan basically between the 80 and the 90% portion of that transaction. So mortgage insurance can be paid in a couple different ways. It can be paid on a monthly basis, included with your mortgage payment. It can be paid in a lump sum upfront as part of your closing costs. It can even be rolled into your interest rate. So you can opt to take a slightly higher interest rate, which some borrowers do because it becomes tax deductible in that instance. So that's one option in order to avoid the 20% down lump sum is, putting less money down, and then you have mortgage insurance. Another option some clients opt for, and it often between the two, when you kind of do the math, sometimes, one way is the mortgage insurance. The other option is getting a small home equity line of credit, which would close simultaneously with your first mortgage. So in this instance, it's almost like just getting another mortgage. Typically the second mortgages have an interest-only payment. You would get them for, let's say, if you're putting 5% down, you would get, let's say, 15% home equity loan. So you have, in essence, you have your first mortgage, the primary mortgage at 80%. You'd have a small home equity loan for 15%, and then your 5% down payment. And there you have 100% of the total transaction of the sales price. So that's another way to offset your 20% down payment, is with the home equity line of credit. Now, there are obviously other types of loans that would not require a home equity loan. For example, an FHA loan. An FHA loan, you can actually finance up to 96.5% of the entire transaction. So in essence, you really only need 3.5% down payment. Again, FHA loans come with mortgage insurance that you would have to pay. And in addition, FHA loans have an upfront mortgage insurance fee that's also rolled into the loan of 1.75%. So it is a little bit more costly than mortgage insurance on a conventional loan. And with FHA, you also have the mortgage insurance that never comes off of the loan. You do have to refinance, would have to refinance or sell your property to knock that mortgage insurance off that transaction. Obviously, with VA loans, or may not be obvious to some of you partners out there. So VA loans do allow you to finance 100% of the value of the property, as do USDA loans. So those two options allow for 100% financing, where no down payment is required whatsoever. So I know that there's a lot of financial institutions out there, mainly banks, that don't even offer VA loans to their clients. And they try to sometimes talk their clients into putting, money down, and to try to put them into a conventional loan, unfortunately, where they obviously qualify for a VA loan. So just because they don't offer it, it doesn't mean it's not available. That's pretty much kind of like a good overall overview of the, options that you have out there today available to avoid a 20% down payment. Amir?
I want to pepper you with some questions now. Okay, so let's say someone chooses to buy a house and doesn't have 20% down. When it comes to mortgage insurance, do they have to go secure it themselves, or do you as the lender secure it for them?
Great question. So with mortgage insurance, we as the lender have to secure that mortgage insurance for them. It's part of the loan transaction because it's escrowed. Well, escrowed, it's tied to their mortgage payment. So we secure the mortgage insurance for them, and it will be included with their mortgage payment on a monthly basis.
Got it. Okay, and then is mortgage insurance determined just like regular mortgages? Is it based on your credit score, the type of property? We've done a video on 18 different things that go into determining your rate. Is mortgage insurance similar, or is it like a one size fits all type of deal?
Great question. Definitely not a one size fits all type of deal. So very similar to determining mortgage interest rates. Mortgage insurance is very similar. So it's the rates are based off the loan amount that the borrower is, or the client is borrowing, how much that loan amount is. There's a money factor, if you will, or a percentage of that rate that's determined, but that factor is determined based on credit score, how much, whether they're putting down 5%, 3%, 10%, how much money are they putting down? The type of property. So it's very similar to the parameters that are needed for determining someone's mortgage interest rate as well in there.
Yeah, that's a great info, Ray. It's really important, guys. A couple of takeaways. I'm going to summarize a little bit what Ray said and get his feedback on a few other things as well. But a couple of things to think about. You do not need 20% down. And I think you would be making an enormous mistake sitting on the sidelines waiting to save 20%. Why? That might be a question. First, interest rates, we all know are heading north. They're going to go up. We don't know when, but they are. We've had 2 years of historical low rates, and it's going up, okay? Then there's a cost of waiting analysis, guys. Cost of waiting, what it means is that, hey, if you wait, let's say I want to wait because I don't want to pay mortgage insurance. I want to wait and raise or save 20%. You have to sit down with your financial planner, your mortgage planner, and we push the idea of financial literacy. You have to be financially literate. What does that mean? It means that if you wait a year from now, first of all, can you save, let's say Ray, most of the states that we're licensed in and we do loans in, I think the average sales price now is probably around 400,000, if not more, right?
More,
so
right.
400,000, let's say 20% of that, guys, is $80,000. Now, let's say you have $30,000 in your bank account. Okay, so you have shy of 10%, right? How do you get to 80? Can you save up to 80 in the next year? Look at your budget. Is it realistic? And if it's not, then you need to act quickly, because that home price, as you guys have been a witness to it, the past 2 years, home prices are going up year over year, 16, 17, 18%. So that $400,000 house, let's just say it even went up 10%, it's going to be a $440,000 house the following year. right? Now you got to worry about making payments on a $440,000 house at higher interest rates just because you waited, because you wanted to save that $100 a month or whatever that number is on mortgage insurance. So guys, Ray and I think we keep hammering it home, and we're going to keep doing so in all our videos. Financial literacy when it comes to mortgages is very important. Cost of waiting is a killer of deals, is a killer of the wealth you could build for you and your family. You're losing out on year over year appreciation. You're losing out on lower interest rates. So there's a lot to think about. I know Ray mentioned it as well too. There's a lot of loans with 0% down. VA financing that Ray mentioned. And as a side note, sometimes we do see lenders talking the families that they're helping out of a VA loan because they don't do it or it's not convenient for them. First of all, guys, shame on them. The VA home loan is an entitlement that a veteran served for and is entitled to. Look, it's a blank check that they wrote with their life for our country, and we're repaying them by allowing them to do 100% financing. If you're a lender out there listening or a realtor, or if you're a family that's looking to buy a house, if you have that VA eligibility, make sure you use it. Don't let people talk you out of it. USDA, Ray, those are for rural areas, correct? Like farmland or
agricultural areas.
Right. Those are 100% financing. And I think we also offer hero loans to our first responders, police officers, firefighters, EMTs, teachers, nurses. We do have those loans as well, where the down payment is less than what was required for FHA as well too. We pair a small second mortgage. Usually it's like a $10,000, $12,000 mortgage. So you really need like 1.5%, to close on a $400,000 house. I mean, think about it. The example we just gave, $400,000 house, 1.5% is $6,000. Okay, so if you invest that money and buy that house, and that house appreciates $10,000, 10% over the next year, your $6,000 investment now gave you a wealth of $40,000. So by just investing that $6,000 and not sitting on the sidelines waiting to raise money, now you're $34,000 more wealthy. That's how it works, guys. You have to leverage these options that are available. Ray named off a few different ways where you could use mortgage insurance to your advantage. There's tax consequences as well too. If you guys get with Ray or myself, we will do a mortgage plan for you. Again, a mortgage plan, not a fee sheet. Most lenders give you a fee sheet. Here's your fees. Here's what I'm charging you. That's not a mortgage plan, guys. You guys want to forecast into the future to see where you and your family are going to be. And we're happy to provide that for you. It's part of our advisory service. We're not guys that just put you into a loan to do a loan. We're a company that looks out for your future and your generational wealth as well too, by teaching you and educating you as to your options. And we allow you guys to make informed decisions, not what's right for us. That was a long few takeaways, but
Well, it's well said. I mean, listen, you're hammering home the point of how important it is for, it's wealth building, it's generational, sitting on the sidelines. It's really, you're really losing out by sitting on the sidelines, especially, everything that you touched on, Amir, with interest rates, potentially rising, appreciation going up and so forth. You're really missing out on so much stuff, and you're really missing out on, the generational wealth and building future wealth for your family, which we talk about a lot, and try to impose, almost impose on our clients to let them know, use the term earlier, financial literacy. It really does come down to financial literacy for our clients. A lot of times when we have these conversations with them, to explain to them, look, yes, you're going to have your closing costs. You're going to have, this is your interest rate. But look at it from a wealth building perspective, right? You're going into this property and, you're putting whatever it is, 3% down, 5% down, this home down the road. This is part of your, this is part of your portfolio, right? And your mortgage is your largest debt, as we've said so many times, right? It's your biggest liability. yes, the home is your asset, but you have this huge debt associated with it. What are we going to do to get rid of this thing down the road,
Right.
right? And minimize it as quickly as possible. So
just one last question to ask you, Ray. So I've seen a lot of clients that have, taken our advice and not wait and jump in with both feet with 3%, 5% down. And they've rode this market, the market that we've had. And the market, guys, it's not just the past 2 years. COVID has made prices go up really high the past 2 years. But if you look back from right after the Great Recession, I don't want to say 2010 or 11, every year prices have gone up. Now, they haven't gone up at 16% a year, but you could look around, 3-4% appreciation has been a yearly thing. And that appreciation compounds on top of compounds. But what I was getting to is we've had people that have jumped in last year, okay, with only 5% down. And this year, the mortgage insurance disappears, right? Can borrowers come back and get rid of their mortgage insurance?
Absolutely. So the quickest way I would say to get rid of the mortgage insurance is obviously, they refinance out of it, right?
Right.
However, the mortgage insurance will stay on a loan for, if it's on a conventional loan, for a minimum of 5 years, so 60 months, right?
Right.
Or they can pay down their principal balance, right, as they're paying down their principal balance with payments. Now, if they choose to do a lump sum payment to pay down, get it down to like an 80% value for the property, then they of course contact their servicer and get that mortgage insurance removed as well, by doing it that way, right? So, but because of the depreciation, like you mentioned earlier, over the past couple of years, they still haven't met that 5-year requirement, right? So it makes sense for them basically just to do a refinance. And a lot of times we've talked about, changing the term. Look, they've been into the loan for for 2 years, right? Or 3 years. They don't have to go back to a 30-year term. They just refinance, pick up right where they left off to, with a 28-year term or a 27-year term, right? Which we talked about last week.
Absolutely.
But and they're reducing their interest rate and removing the mortgage insurance. So it's literally a win-win all the way around.
Right. And that's a great point, right? I mean, you guys could get into the house with 5% down at the current appreciation levels. You could come back next year. We could do a loan for you again at a 29-year loan or a 28-year loan. Ideally reduce your interest rate or at least keep it the same, but knock off the mortgage insurance where you have freedom of another $150, $160 a month. That, again, talking financial literacy, you can use it to pay down your mortgage further every month by adding it back to your payment, or drop it into your index fund or whatever investment vehicle of your choice, or just save it in your bank for a rainy day. But there are options, guys. So this video ran long. I hope you guys got good information out of it. It's very important that you know your options and you are financially literate when it comes to making such big decisions. Because making the wrong decision or lack of making a decision is more detrimental than making no decision whatsoever. So with that, guys, happy Friday. Enjoy the weekend, and we'll see you guys on Monday.
Happy Friday, everyone. Have a great weekend.
Bye-bye.